The $5,000 milestone. Why gold's 2026 bull run is far from over. The global financial landscape in early 2026 has been defined by one dominant headline: the unprecedented ascent of gold. After shattering psychological barriers and surging past $5,500 per ounce in January, the market is currently navigating a period of high-stakes volatility. While recent weeks have seen prices consolidate around the $5,100 to $5,300 range, the structural bull case for gold remains remarkably resilient. The flash crash of March 2026. As of mid-March 2026, gold XAU dollar USD is trading near $5,113, having pulled back from its January peak of $5,589. This 6 to 8% correction has been driven by a perfect storm of short-term pressures. Rising Treasury yields, sticky inflation data has led investors to push back expectations for Federal Reserve rate cuts, strengthening the U.S. dollar. Oil volatility. Surging crude prices, driven by intensified U.S.-Iran tensions, have forced some institutional traders to liquidate gold positions to cover margin calls in other commodity sectors. Profit booking. After a staggering 55% gain in 2025, a technical cooling-off period was widely anticipated by analysts to reset market momentum. The institutional wall of money. Despite the recent price dip, the underlying demand from the world's most powerful financial entities is creating a formidable floor for the market. 1. Central banks, the price inelastic buyers. For the fourth consecutive year, central banks are accumulating gold at a historic pace. Current estimates for 2026 project total official sector purchases between 750 and 800 tons. Leading the charge is the Reserve Bank of India, RBI, which recently saw its gold reserves cross the $100 billion mark for the first time. This strategic de-dollarization trend ensures steady demand regardless of short-term price fluctuations. 2. The ETF rebound. Global gold ETFs have entered 2026 with significant momentum. In January alone, global funds added 120 tons of gold, the strongest inflow month on record, valued at nearly $19 billion. While February saw a 78% moderation in these flows, dropping to roughly $4.9 billion, the total assets under management (AUM) for gold ETFs remain near an all-time high of $669 billion. Expert forecasts, the road to year-end. Wall Street and European banking giants remain overwhelmingly bullish for the remainder of 2026. JP Morgan forecasts gold to average $5,055 in Q4 2026, with an aggressive high-side target of $6,300 if fiscal stress intensifies. Recently raised its target to $6,200 for the middle of the year, before a projected slight easing to $5,900 following the U.S. midterm elections. Goldman Sachs projects a steady climb toward $5,400 by year-end, citing the diversification trade as the primary driver. Investment outlook. As gold tests critical support levels near $4,995, technical indicators like the 200-day simple moving average, currently at $3,969, suggest the long-term uptrend is firmly intact. For investors, the current consolidation isn't seen as a trend reversal, but rather a breather in a structural shift toward hard assets. With global debt levels rising and geopolitical flashpoints multiplying, the consensus is clear. In 2026, gold is no longer just a hedge. It is the cornerstone of the modern macro portfolio.